right, welcome back to another edition of our monthly video. And this is a big one. We have Eric back in studio.
Yes.
We're happy.
I could look.
We can talk the family's back. And I'm thrilled. We're all thrilled. And there's just something that I'm just very, very confused about right now.
What's the matter, Rob?
There's something around your neck. There's some sort of material. I'm not really sure what is that actually.
You know what? I'm not sure myself. Someone said they call this a tie. Tie, I think.
Okay.
And I just felt like now that I'm back here in New York and we're reunited, which is emotional. I felt like I'm just going to go one step above. So someone said to me, Rob wears the tie. Maybe you should try one. Oh, I know who it was. My wife. It was Lori. So anyway, yeah, I'm wearing it, and I have to tell you, it's exciting.
Man,
I'm enjoying it.
Man, it looks good.
I feel good.
All right. Well, let's get right to it. Incredible volatility. Boom, right? Just incredible volatility. And I'm happy to say some of the things that we were speaking about and some of the themes that we've been speaking about and bringing up seem to have been coming to fruition. So let's talk about this bull market that the NASDAQ 100 has happened. It's really a recovery. It's a recovery from the bottom up. Right now, NASDAQ 100 up literally 25%. It's still not where it was. One interesting fact, I know Eric has all sorts of interesting facts, but one of them is the NASDAQ 100, invented in 85, had 8 bear markets, and 4 of them were fake outs. It went down, went up, and then went down further from where it started. 4. Is this the
So the recovery was a fake out?
That's right. So we're on a 25% recovery. Could this be a fake out? Is it the calm before the storm? That we can't answer, but it's a recovery nonetheless.
Yeah, and by the way, a bear market, just to be clear, is down 20%. And so in this last Liberation Day sell-off, the NASDAQ had a bear market. NASDAQ dropped over 20%, and the S&P got pretty close. So when Rob talks about up 25%, that's just all recovery. Mm-hmm. Year to date now, the S&P is barely positive after this big recovery. But Rob, I think the big story here is that a lot of risk has been taken out of the market. Really, it's just in the last week or two. Specifically, China is big. That was the elephant in the room. We had 145% tariffs. We had a meeting, and boom, tariffs dropped to 30%, and we have a 90-day pause, and that's just a huge relief for the markets. And so you've got a big rally. And what's interesting is one of the reasons why the market's doing so well, in my mind, is the negativity. I always talk to you about go the other way. When everyone gets negative, go the other way. Sometimes you got to close your eyes and just stay there and not watch. And just to be clear, the VIX is the fear gauge. That is a measure of fear in the market. And it got to one of its highest numbers a month ago, and it is now at a calm. This is a record, Rob. We've never had in 1 month a reading so high,
60,
and 1 month later, we're down at 19, which is called calm. It all happened in a month.
Yeah, these are huge volatility numbers. And listen, let's be clear. This China negotiation is a negotiation. It's not a deal. It's ongoing negotiations. We have a 90-day reprieve. That's going to be up in August. The current 90-day reprieves are up July 9th, right at the beginning of the third quarter. So we'll see how that plays out for earnings season. But there are some things that are making people cautious. Earnings season, we're in the midst of it, second quarter. And the projections for earnings growth were revised. It was 13, got slashed down to 7. So with earnings projections being slashed down, why is there optimism? One of them is tariffs. I have a couple of deals done in negotiation, not done negotiation. You have some great things with hard data. CPI just came out, 2.3. PCE, 2.6. Wage growth, 3.8. Difference there. Inflation.
What about the PPI?
PPI
was down a negative 0.5%.
Yeah, that's huge.
And the core, getting rid of food and energy, still negative 0.1. Negative.
Yeah, these are big. And a jobs print at 177,000 jobs. That's coming off of a revised number of 180. Just to give you an idea, between 100 and 150 is usually pretty good. So the hard data itself is good. So what's happening here? A little bit of pullback of nervousness. And you can see it. The market this week in recording has kind of just been sideways, right? Going a little bit of a reprieve.
I mean, we're rising. We're rising. We're not making new highs, but we're recovering. And look, we're not out of the woods. All right. But the reason why I said a lot of risk has been taken out is that every time the markets had a big sell-off, Trump backs off. And I believe it's Bessent. Bessent was a hedge fund guy. He's been in the markets a long time. And Trump came out with those reciprocal tariffs. The market got hammered. And all of a sudden, Treasury started selling off. Bessent said, stop.
Right.
He did. Then Trump started hammering Powell. I can't wait to get rid of that loser. That's what he called him. The market dropped 1,000 points. Next day, Trump said, I'm keeping Powell.
All good.
He's good till at the end of his term. So we're seeing China, right before they had their meeting, he said, I'm not backing off of these 145% tariffs. And then boom, down to 30%. So the markets are starting to learn that this is how Trump operates. He starts up here. He sees everything as a negotiation. He starts here to end up there. So you never should listen to those, whatever those first numbers are, that's scary to death. Just don't listen to it. It's not where we're going to end up.
Yeah, and we've always said we're one tweet away from a huge bull market or a huge bear market. And that's, I think, one thing that makes this particular time frame a little bit different than other time frames. One person really has a huge, huge effect on where we're going. So when you take it all into context, look where we were. 12/31, the average tariff into the United States was about 2.3%. Now, the effective tariff rate about 13%. So even though China went down a lot, it's still a huge difference from where we are. That's inflationary.
Yeah.
Right? It will, if it continues, we're not supposed to speak in, definitives, but it should absolutely have an effect on inflation. And again, we'll see where these roll out. One other thing related to tariffs from an inflationary perspective is a company has a choice when there's a tariff, pass it on to the consumer or eat it and skim their margins lower. So Walmart just announced a big change, right? They're passing it on to the consumer. Raise the prices. Other companies are going to eat it. So it's very sector and product specific. So where that all lays out in the end, still to be determined, still uncertainty. So we're not out of the woods.
Yeah, let's be clear on something. The University of Michigan consumer sentiment number just came out for April, second lowest reading ever. Okay? Number of bears out there, it was 60%, which was ridiculous. It's still over 50%. 11 straight weeks. That's a record. That's never happened.
That's the AAII.
Yeah, that's right.
Yeah,
so
never happened.
The number of people bearish, right. Over 50%, 11 straight weeks. Right. So what is going on? Because we're saying risk is reducing. It is. At the end of the day, as Rob just alluded to, tariffs are not going away. They're here. We don't know exactly how much, but they're here. And what do? We know that they raise prices, and we know that they reduce growth, at least in the short term. That's called stagflation. That's an ugly word. No one wants to hear that word.
No.
And that's why consumers, Americans, individuals are still cautious. Even though we're seeing this progress, people are still scared.
Yeah. And there are bright spots in the investing world. And I know Eric wants to speak about this. I'll just open it up by saying a real surprise year to date. Big surprise. You look at the EFR, it's an index of international. It's up, I'd say roughly about 14% right now. That's huge. No one saw that coming. There's big value in Europe. It was recognized. A lot of money flew into it. And you've seen that index go through the roof. So it's an interesting international moment.
It is. And I think what we need to realize is, first of all, internationals underperformed the U.S. dramatically over the last decade, both emerging market and international. Go back to the tech bubble popping in 2000 to 2010, the S&P made nothing. And if anyone remembers BRIC, Brazil, Russia, India, China, emerging markets had an amazing decade. And then internationals backed off.
The lost decade for
the lost decade for the S&P.
S&P.
Nothing for 10 years.
Right.
So here we are now. There's been underperformance for a good 15 years. International's gotten dirt cheap. And what's the catalyst? All these tariffs and Trump saying, guess what, Europe? We're not protecting you anymore, okay? You got to step up and do your own. So Germany announces a huge spending bill. They do not have the type of deficits and debt that we do. They are cutting interest rates. We're waiting for the Fed to cut. They're cutting. They've been cutting for a while. And in the meantime, the US dollar, which has been strong for years, is down. It's down big. And that is a tailwind when you own international stocks and the dollar gets weaker. Those international earnings translate into more dollars.
Right.
And that's a win as a US investor. So that is why you're seeing, oh, and last thing I should say, earnings expectations are increasing for international companies while they're being cut for US companies. So there's just a lot of momentum switching. And this gets back to what this smart man and I have said a gazillion times: diversify, stay with your plan, rebalance. That means when international is going down, guess what? You're buying more of it.
That's right.
And waiting for what just happened.
That's right.
Right. And so diversification is really working right now. Really happy about it.
Yeah. So there are, like we said, some bright spots: international, infrastructure. One area that's just continues to struggle, started coming up big, small caps. Small caps continue to have a hard time. The Fed is keeping interest rates high. That does affect small caps greater because they're typically more debt dependent than larger companies that are pretty much self-funded with Google, even tons of cash, a mountain of cash. Small companies don't have that. So going forward, again, I've heard people say, where should we be putting our money? Where you put your money is you diversify it. When things do really poor, time to buy. We've been buying areas that were lagging, and those areas will come back, and vice versa, trimming things that have done very well, putting those profits into other areas. So fancy word for that, rebalance, but really selling high and buying low. We've been doing it a lot. So a lot of volatility, a lot of tax loss harvesting has been happening. Things go down, create tax deductions.
Yep.
We've been doing that as well. So a busy time for the Wealth Alliance, but I think the portfolios are holding up very, very well in this time frame.
Yeah, and there's one more thing I just like to mention. As we know, the bond market's been pretty flattish this year, but one area of the bond market's been a little weaker, and that's tax-free municipal bonds. And it's just a variety of reasons. One, when interest rates go up, the value of bonds comes down. But also there was a huge amount of supply that hit the market. That's a seasonal thing that happened in April. And the Trump administration does have on its list of lots of different things to discuss. One of them is possibly taking the tax exempt status of some municipal bonds and changing it. By the way, that's been on the table
For a long
many times. It's never gone through because it would really alter the financing costs for municipalities. And everyone we've spoken to in the municipal world does not believe it will go through, or if it does, it'd be very, very selective. The bottom line is tax-free municipal bonds generally yield about 78% of taxable bonds, treasuries. Right now, they're yielding about 90% of those treasuries. We're seeing really good tax-free yields out there. And if you're in a medium to high tax bracket, that's a no-brainer.
Yeah. Muni high yield, again, very, very low risk of default, clipping a very, very high coupon. And when you put the tax effective rate on there, it gets pretty high. So it is a unique time for the bond world. Yields, low risk of default. And finally, that asset class has become a protector against equity moves as well as give a strong yield. We've been waiting for that for many, many years, and it's happening. So we feel pretty good about that. So what do we take from all this? big volatility. We saw in one day an entire year's worth of rate of return, 9% happen in a one-day move in the market. That is unprecedented. It's huge and it's scary. And we get that. But hopefully all of you are looking at your statements, seeing what's going on, maybe seeing a bigger picture and realizing that some of the uncertainty, some of the fear is dropping down a bit, which is a good thing for normalcy of markets. And that's what we're looking for.
Yep. You know, we've talked about extreme negativity, and it was just interesting. I read something today that during April, the Schwab Trading Index had the most record selling by individual investors since March 2020. That's the middle of COVID. That's right when COVID hit and the stock market dropped 35%. And that's where it bottomed. I'm not calling the bottom, but there's a decent shot that we may have seen the bottom in this cycle because we saw such record amounts of selling. That is what makes bottoms.
Yeah, and I wouldn't say we called it, but sometimes it's better to act more than just what you say. We were buyers of equities during that time frame, and I'm glad we were. I think our clients were rewarded as a result. So that being said, we're feeling pretty good going into the summer months, feeling great. Eric's here. That always makes us feel great. But our portfolios and what we're doing make us feel great as well. And above all else, we love you and thank you for being our clients and hanging in there during a very difficult time with a lot of good phone calls and a lot of good discussion.
Yeah, I'm so happy to be back. I always love being back in our Melville office. Like to leave you with two thoughts. One, Trump so hammered into the world to buy American that the Pope is American. First time ever.
Trump.
That's
he must be the reason.
It's unbelievable.
It's got to be the reason.
And Pope Leo the 14th. So honestly, it looks like an amazing
Bob, who went to Villanova.
Bob.
Villanova Bob.
Villanova Bob.
Right.
And I'm glad you brought up, we getting towards, say Villanova, I think basketball. And that's my last thought I'm going to leave you with. And if you're not a New Yorker, I'm sorry, but you don't know what day it is. But tonight, the Knicks can clinch it, knock the Celtics out, and move on. And I got to tell you,
We're psyched.
I love those Knicks. It's never happened ever that back-to-back playoff games, a team was down 20 points or more and came back. Never happened. Our New York Knicks did it. Go New York, go New York, go.
Go Knickerbockers. Thank you.